All right, let's just get right into it. It's Tuesday, January 20th, 2026, and if you're looking at your screen, you're seeing a sea of red. So what's going on here? Well, it's not just one thing. We're actually seeing two completely different crises smashing into each other at the same time.
First up, let's look at the big picture. The S&P 500, down almost 2%. And think about that for a second. Weeks of gains just gone, wiped out in a matter of hours.
And if you think that's bad, take a look at tech. The Nasdaq is getting hammered even worse, down more than 2%. You know, your big names, Nvidia, Amazon, Tesla, they are all taking a nosedive. And here's the kicker. It's got nothing to do with their earnings. Something much bigger is going on under the surface.
Now this right here, this is how you can actually see the panic in the numbers. We're looking at the VIX, the market's fear gauge, and it has absolutely exploded. We went from a pretty calm 15 yesterday to over 20 today. That kind of jump, that tells you this isn't some nice, neat, orderly selling. No way. This is a market that is genuinely spooked.
So what in the world is going on? What's driving all this chaos? I mean, you look at the headlines and it's all Greenland, Greenland, Greenland. But there's this other, quieter problem, a really serious liquidity crisis that's brewing over in Tokyo. So that's the real question we've got to figure out. Is this big sell-off all about Greenland? Or is it something to do with a meltdown in Japanese bonds?
All right, so here's our game plan for today. We're going to break this whole thing down. First, we'll tackle that tariff threat over Greenland. Then we're diving into the liquidity trap in Japan. We'll compare the two big bond trades at the heart of this mess, figure out where the real safe havens are, and then wrap it all up with a survival playbook for you.
Okay, let's start with the one everyone's talking about, the big, loud explosion that's rocking the market. I'm talking about the tariff threat over Greenland. This is, without a doubt, the immediate trigger for what we're seeing in U.S. stocks today.
So here's what's happening. President Trump, now in his second term, is really ramping up his push to acquire Greenland. And it's gone from just talk to economic warfare, basically. We're talking about a threatened 10% tariff on 8 key European countries. Think Denmark, the UK, Germany, France. And this isn't some far-off threat. It's set to start February 1st, and it could jump to 25% by June. This is a direct shot at the transatlantic trade corridor. It's putting massive cracks in the whole global trade system that so many companies depend on.
Okay, really important point here, folks. There's a ton of confusion about this. When you hear people yelling about Greenland Bonds, your first thought might be to look up a company called Greenland Global Investment. Whatever you do not buy these. That is a Chinese real estate developer, and trust me, that's a super dangerous sector to be in right now. When people talk about Greenland bonds, what they actually mean is the government debt of the Kingdom of Denmark. Why? Because Greenland is a Danish territory.
And this creates a really weird situation, a total paradox. I mean, Denmark has a perfect AAA credit rating. Its debt to GDP is crazy low, under 30%. In any normal universe, this is the definition of a safe haven asset. But right now, today, it's ground zero for a massive political firestorm. So buying Danish bonds right now, it's not a bet on their amazing economy. It's a bet that diplomacy is going to win out. You're basically placing a bet against political chaos.
Okay, so Greenland is the loud, obvious explosion. But now, let's talk about what's happening in Tokyo. This is like a silent radiation leak. You don't see it as clearly, but believe me, it is way more systemic and, frankly, way more dangerous for the entire global market.
Check this out. The yield on the 10-year Japanese government bond, the JGB, just hit 2.34%. We have not seen a number like that in 27 years. Now remember, when yields go up, bond prices go down, so JGB prices are cratering. And the reason why is a classic policy collision. You've got the Japanese government wanting to spend a ton of money, while at the exact same time, their central bank is trying to tighten things up. And that tug of war, it's literally breaking their bond market.
So why should you, an investor in U.S. stocks, care about any of this? Well, it all comes down to something called the yen carry trade. For decades, it's been the secret sauce of global markets. Big investors would borrow Japanese yen for practically nothing, like zero interest, and then they take that super cheap money and buy stuff that pays more, like U.S. tech stocks. This trade has been a gigantic fire hose of cash for the whole world.
And now, that whole engine is sputtering and running in reverse. Here's how it works. When those JGB yields spike up, the whole carry trade falls apart. All those investors suddenly have to sell their U.S. stocks, not because they want to, but because they have to cover their losses back in Japan. Then they take that cash and send it home. This is the reason you're not seeing anyone buy the dip today. That big pool of money that usually rushes in, it's being hoovered right back to Tokyo.
Okay, so let's put these two side by side.
You've got Danish bonds, which are all about political risk. And then you have Japanese bonds, which are facing a cold, hard mathematical risk. So which one is the lesser of two evils here?
This chart really breaks it down for us. Look, Denmark's problem is political. Yeah, it's messy, but they've got central banks ready to jump in and calm things down. Japan, on the other hand, their problem is pure math. It's a structural fight against their own debt, their demographics, and they have a central bank that's now being forced to fight inflation. So what's the verdict? Danish bonds are probably going to be choppy and trade sideways, but Japanese bonds, they have a long, long way to fall. It's like this. Denmark is a victim of politics, Japan is a victim of math.
So if these two massive bond markets are basically poison right now, where is all the money going? Where is the capital actually fleeing to? Let's take a look at the real safe havens popping up in the middle of this storm.
Well, you don't have to look much further than commodities. Gold is on an absolute tear, smashing its old records and trading over $4,700 an ounce. This is a classic flight to safety. It's what happens when government debt itself becomes the risk, instead of the thing that protects you from risk.
And it's not just gold. Silver's right there with it, knocking on the door of $95 an ounce. So this isn't just a story about one precious metal. It's a much bigger move into hard, physical assets. It's what happens when investors start losing faith in paper money and the promises made by governments.
This chart really shows you the massive shift that's happening. You can see capital just pouring out of the old standbys, government bonds, stocks, and gushing into hard assets and commodities. People are completely skipping the usual flight to quality because the quality of that government debt is the very thing everyone's questioning now.
All right, let's turn all this into something you can actually use. This brings us to your survival playbook. These are the key things you absolutely need to be watching as we head into what's looking more and more like a new age of scarcity. If you take away only one thing from this entire breakdown, let it be this. The rules of the game have changed. For the last decade plus, holding cash meant you were losing. Cash is trash, right? Well, not anymore. Today, cash is no longer trash. It is a strategic asset. It gives you options. It gives you power when everything else is going crazy.
So here are the things to keep your eyes on, your North Stars in this storm. First, you have to watch that 10-year JGB yield. It is the master key to global liquidity right now. Second, keep an eye on the US dollar versus the Japanese yen. If the yen gets stronger, that means more pain is coming for the Nasdaq. Third, just stay away from the high beta stuff. You know, the more volatile assets like tech and crypto, at least until things calm down. And last, but definitely not least, hold some cash.
Look, the choices you make in the next few days could really set the stage for your entire year. What we are witnessing right now is the great unwinding of a decade of easy money and a decade of peaceful global trade happening all at the same time. So I'll leave you with this question. The era of easy money is officially over. Is your portfolio truly ready for the age of scarcity?